Hello, and thanks for joining us today. We are through both Republican and Democratic national conventions now. We know who the candidates are, at least their names, if not what they might actually do in office. And now comes the communication contest to see who can effectively persuade the most voters by the end of the day on Tuesday, November 5th. If this election cycle is anything like previous ones, there will be plenty of hyperbole, vague policy descriptions, big promises about lives being so much better or worse, and very creative uses of facts, figures, statistics, and what Malcolm Gladwell calls revisionist history. So what does this mean for you and me as investors and people with financial goals? Well, among other things, it means we'll need to find ways to keep our wits about us, to not panic, and recognize that the media, news, social, and otherwise, is out for our attention, not really for our portfolio or financial plan's best interests. So how do we keep calm and carry on? Well, one way is to recognize the signs of cognitive bias or bad thinking that can emerge when we pay too much attention to electioneering rhetoric. If we can step back and ask, am I falling into fill in the blank here, we might just be able to keep a bit calmer and laugh at ourselves, which are both good practices for decision making. Nobel laureate Richard Thaler is a pioneer in the field of behavioral economics. On a recent Freakonomics podcast, host Steve Dubner asked Thaler to describe the field, behavioral economics, in a way that fits on a bumper sticker. Thaler's response was great. He said, "We don't think people are dumb, we think the world is hard." Cognitive biases and decision-making errors make the world hard. Here's a few I think are important to look out for in ourselves and others in the next 3 months. So thinking error number 1, overconfidence. Research finds again and again that human beings tend to be overconfident, especially in our ability to know the future. In an election season, this bias could show up as an overconfidence in predicting who will win, what they will do when they get in office, and what the result to the economy and the stock market will ultimately be. Maybe the best recent example of how this did not pan out well for some was in the 2016 election. Going into Election Day, the conventional wisdom and the polling data had Hillary Clinton defeating Donald Trump at the polls. So markets expected that result as well. When it became apparent during the evening of the election coverage that perhaps Donald Trump was going to win, stock market futures began to go down a little and then a lot. The market went from one overconfident prediction, Clinton winning, to a second one, Trump will be bad for stocks. Both were wrong. Clinton lost, and the stock market did very well under Trump until COVID-19 upended things in 2020, but only temporarily, from February's steep decline to the full recovery by middle of August. Right now, supporters of both candidates are telling us with a great deal of confidence that their person will be good for markets and the economy, and the other person will be bad. Here's where a little history is helpful. Both the U.S. stock market and the U.S. economy have done well under Democrats and Republicans. And for the majority of the 2-year election cycle since World War II, 61% of the time, Washington has had some form of divided government where real GDP and market returns, while positive, were actually less so than when one or the other party was in control. Now, I track 17 various iterations of control between which party controls the White House, the Senate, and the House of Representatives. Every 2 years during election season, I update the numbers. What I can tell you is that you can find something in them to use against or in favor of both parties. Just looking at Democratic versus Republican presidents, you see a 14.8% versus 9.3% stock market return advantage to the Democrats since 1926. Looking at control of Congress, Republicans hold a 15.1% to 12% market return advantage over the same period. So who's better for the market? Well, it depends on the story you want to tell. These are just a couple of good examples of figures that don't lie, but liars, or let's call them storytellers, often figure. What about thinking errors 2 and 3, narrative and confirmation bias? We love stories, and as the saying goes, the best story wins. Why does the best story win? Because we want a narrative that makes sense of the events happening every day. If we can find a narrative that seems to explain things well, we'll feel more confident in understanding and predicting the future. It's back to that overconfidence error. Now, confirmation bias supports or makes our narrative bias that much more powerful and potentially harmful. Once we have a story we like, we start looking for evidence to support it. Again, study after study shows that we will give extra weight to the facts and figures that confirm our preferred narrative and discount or ignore those observations that would conflict with or contradict the story we like the best. For example, if you like the storyline that Democrats are better for the stock market, you'll point to the advantage Democratic presidential terms have had in stock market returns over Republican presidents. But you will de-emphasize the statistics showing Republican control over Congress has coincided with higher stock market returns. Now, the reverse is true for the Republican storyline. What if the real storyline is that markets do relatively well under all kinds of partisan control iterations? Our recent favorite example of this looks at what a hypothetical $10,000 investment in the S&P 500 stock market index starting in 1961, just happens to be the year I was born, would have done if investing only during years Republicans were in the White House versus only during years when Democrats were in the White House. Now, of the 62 years from 1961 to 2023, the split between Republicans and Democrats is 31 to 31. So no advantage in number of years. If invested only in the 31 years of Republican presidents, that $10,000 would have grown to $102,293. Now, if invested only in the 31 years of Democratic presidents, that $10,000 would have grown to $500,478. That's quite an advantage. But, and this is the most important takeaway here, if the $10,000 had been invested for the entire 61 years, it would have grown to over $5.1 million. Now, the lesson here is that compounding and long-term investment are far more powerful than which party happens to control the White House. So beware of falling in love with a story so much that you discount or ignore contradictory evidence. Usually the real story is more complicated than we want to admit, and outcomes, well, they're just far less certain than what we hope for. Okay, thinking error number 4, catastrophizing. I find this one notoriously complementary to the first 3 when it comes to election seasons. If we are overconfident in our narrative and screening out facts to the contrary, the narrative of what will happen if the wrong person wins leads us to believe that all worst case and imaginable negative outcomes are now highly probable, even when the facts say they are not that likely. I find in listening to my own thoughts and the words of others that catastrophic thinking is very often overconfident fear. Data from 1992 to 2020 shows that stock market volatility as measured by the VIX, which is also called the fear gauge, well, that tends to increase in the months leading up to a presidential election and then decline afterwards when the results are known. Now combine this with our U.S. media environment, including social, cable, and traditional news media, which studies now show are all measurably more negative than news media in the rest of the world, and you have the perfect soil for growing high levels of catastrophizing, of developing an overconfident fear of the very worst things happening. So what's the antidote to all of this? Well, if you've been listening to us for any length of time, you know this quote, educated optimism is an antidote for anxious uncertainty. That should sound familiar. Every 2 years, when I look at market performance and election outcomes, my own research and the research of many others, what stands out is the lack of attributable effects that elections have on markets. That's not to say that elections are not important, but it may show how resilient markets and the U.S. economy really are. Longtime senior researcher John Reckenthaler from Morningstar put it this way recently. My claim is that for equity shareholders, elections do not bring significant change. No matter who wins, the economic underpinnings remain largely intact, and those underpinnings have been very, very good for stock prices for several generations. He closes his piece with this. There are many reasons to vote in November. The performance of equities is not among them. So instead of letting these and other cognitive biases and mistakes ruin our mood for what's left of this summer and the upcoming fall, better to be on the lookout for overconfidence, narrative and confirmation bias, and catastrophizing in ourselves and others, and let's find some humor in it. Let's give ourselves a break. Maybe that break needs to include limiting the intake of media, especially some of the partisan cable news networks like Fox and MSNBC, and social media networks that have already picked up on all of our biases and have algorithms created to exploit them. As Nobel winner Richard Thaler says, we don't think people are dumb. We think the world is hard. Let's not make it harder by missing out on reasons for educated optimism. And if you're looking for more on the upcoming U.S. election, including a review of the candidates' potential tax and economic policies, as well as positions on the country's long-term issues like entitlements, debts and deficits, and even economic foreign policy, we invite you to join us for our upcoming special election webinar on October 23rd. You can register at fostergrp.com/webinar. Now, our goal is for these podcasts and our webinar to contribute to you, our listeners, becoming educated and prepared optimists. If you're listening to this as a podcast, you can help us spread the message of educated optimism by liking us on your podcast app. As always, thanks for investing some of your valuable time and attention with us today.